Good morning, everybody, and thank you for taking the time to listen to our quick update on the Numen Credit, the Hedge Invest Numen Credit Fund. This is a quick update that we want to have and share with you to talk about the outlook and the expectation we have on the portfolio. In terms of outlook, our expectation is that the market are about to enter much more interesting period for us in terms of volatility and various events that we expect to affect several asset classes, first and foremost fixed income and credit. Obviously, we all are aware of the geopolitical risk, which is increasing, and it's not just confined to North Korea. There are other very hot spots in the world. We think Qatar and Venezuela are among the biggest concerns for us, especially given the impact that could have on demand and supply on oil and the implication would have for inflation expectation. Away from that, obviously, we have a very disorganized and ineffective administration in the United States. The market is slowly recognizing that fact. We think there could be a decent amount of confrontation in Congress with the debt ceiling and the new budget. And that's a second area of concern for us from a geopolitical point of view. Away from that, on the pure fundamental side, obviously, the economies have been improving and they are stabilizing at around the current run rate in terms of growth. Europe has been particularly good. It's been exceeding the expectations, and I think there is where we see much more space for normalization of monetary policy, more than anywhere else, more than US, more than Japan. With that in mind, we do expect the ECB to advance their normalization agenda already this week, although quite slowly and in a progressive fashion. But we think that will accelerate towards the end of the year. So we do expect fixed income to be potentially very much impacted by those two sets of drivers. We could have a situation where the geopolitics make the oil price much more unstable, possibly spiky. And on the other side, obviously, we have a normalization of monetary policy, both in Europe and in US. Looking at the portfolio, obviously, we are positioned for those events. We have several hedges, long tail hedges, which at the moment are incredibly cheap. Just one simple example would be the South Korea CDS, which is trading at close to the all-time tight for the spread. We're talking about low 60 basis point for a country that could be entering into a devastating nuclear confrontation. Away from that, obviously, we are quite concerned about the US. From a macro point of view, our biggest position remains United Kingdom. We think there will be a serious acceleration there with the Conservative Party conference in October and European Council summit at the end of October. There is an increasing amount of probability to be attached to a no deal, Brexit with no deal whatsoever, so falling down the WTO, and that we have as a growing probability scenario. Away from that, we like periphery. We particularly like Greece. We think could be benefiting from the new German government going forward. And so we're very confident on those positions, especially for the next 3 or 6 months. Away from that, we really like the banking system in Europe. I think both on a selected basis for some of the equity and some of the credits. Predominantly our long positions in credit, but as you know, we have a portfolio of they've been quite stressed and distressed financial institutions, such as Monte dei Paschi, Carige, Novo Banco, and I think we've seen this year there's been great opportunity in that space with the short we had of Banco Popular. Those actually happen to be long. We think there's a very meaningful acceleration on, especially on Paschi and Carige. So we think we have good expectation there. Away from that, the last sector we are quite involved is corporates. There are several trends in corporates which we are following, we are positioned for. One of these, the M&A activity is increasing. We are quite involved there with Biscayne, Monsanto, and some other names. At the same time, I think we seen the first signs of what could be a very big trend going forward, which will be the impact of technology on in traditional leveraged sector. I think we're seeing the impact of Amazon on retail. We think another major disruptive wave could happen on media. We're positioned there with decent shorts on a lot of the media companies that we think are very levered and very unprepared to manage not much the threat from small guys like Netflix, but more the threat from the super big guys all competing for the same pie, which are Facebook, Google, Amazon. And so we're preparing there with a decent amount of shorts. Overall, obviously, our view remains the same. Valuation incredibly stretched, especially in fixed income. We do expect a normalization there, both via central banks and possibly oil shocks. So we are prepared for that, and we think there's going to be very interesting opportunity going forward, and we are positioned a portfolio for that. Thank you.